Sandeep Sabharwal is joining us now on fundamentals along with Nuresh and Kunal on the charts. Gentlemen, good afternoon. Thank you so much for your time. Sandeep, let me start with you. Uh, we may have made a high on the mid cap, small cap, say sometime in the mid of Feb, and we were kind of grinding lower, but the selling got accelerated in the last 2-3 days. Looking at the screen now, are you getting a sense that bulk of the damage has already happened and one should start dipping their feet in the broader market now, or would you like to wait and see things settle down before starting to allocate money back to broader market stocks?
So settling down or not, it doesn't matter to investors like us. So what is more important is that to measure the magnitude of the correction and look at historical trends on how corrections play out and estimate if the correction is over. So by all those estimates, it doesn't seem to me that the corrective move could be over as of now because of the fact that we had a few days of fall. The correction from the top is not as much as what would typically be there in any bull market correction. And also the fact that the sentiment continues to be buy on every dip. So that sentiment has to become a bit more fearful for some sort of bottoming phase to be made. So I think we could be still a few weeks off a durable bottom. And I would think that speculative activity and stocks are still high because the kind of bounce backs we are seeing today, they also seem to be unnatural after the fall yesterday. So it's better to wait and watch. This is not the end of the rally. It is a bull market correction and it will end in a few weeks. And that will be the time to buy and then we could play the next supplement.
Okay, so the bull market is intact, but we might not be done with this correction yet. A few more weeks of grinding lower, and perhaps then is when the durable bottom will be formed. That's the verdict coming in from Sandeep. But for now, India VIX has cooled off quite materially. In fact, that index is down almost 5%, and now closer to the level of around 14. So at least the volatility seems to have been sucked out of the system for now. But Kunal, would you concur with the view of Sandeep that perhaps the bottom is not yet made, or do you see signs on the charts that tell you that if not the bottom, we are very close to that?
So, ideally what happens, Anisha, is that after a sharp sell-off or a correction, there is a first flurry of a bounce or a relief rally. That's a more prominent term which we typically use for indices and for stocks. Post a rise or post this relief rally is where the index or stocks, they generally come closer to testing their previous support. So we call it as a double dip where the indices or stocks which have fallen sharply, they go into retest of the previous swing lows. Ideally, in the second scenario is when the stocks or the asset classes, when they retest the previous lows, the volumes are much lower because majority of the volumes, they generally get capitulated in the first leg of sell-off for the respective asset classes, and then starts a process of a very slow, gradual, steady recovery for the indices and for the stocks. So I would believe that we've completed the first phase of a sharp correction. We are in the process of a relief rally for individual stocks. Maybe this process could take another 1 or 2 weeks. But I think an ideal retest of the previous swing lows could probably be a more stronger determination that we formed a formidable support for the indices. So so far the Nifty Mid Cap Index, both of these indices are holding on to their key moving average supports. Just for example, the Nifty and the Bank Nifty both have come back to their 50 DMAs. The Nifty Mid Cap Index, we were discussing this yesterday, has come back to its 100-day moving average. So in terms of short-term support, yes, the short-term supports are established. But as I said, that possibly a double test of the previous swing lows is an ideal retest or a confirmation that the near-term bottom is informed.
Nuresh, you have worked on the small cap index in terms of charts. I saw some of your tweets. How does the setup look right now?
So the setup is simpler. If we look at the rally which started from March 23, we've had a rally from say sub 26,000, 27,000 small cap index to almost 46,780. As of yesterday, we had a 13-14% dip from the highs. We went back to the same lows which we saw in December 23. And at that point of time, Nifty was at 21,000. And the previous major support comes to around 38,700 on the BSE small cap index. That would make it a 17% dip from the top. And Nifty at that point of time was at 20,000. So I would expect 13 to 17%. This is the kind of area where we should create a short-term bottom. And overall, what happens is people want to buy the exact bottom. But the fact is, every stock in the small cap index will not bottom out with the small cap index, just the same way it did not top out on the upside. So out here, from yesterday, like I've been mentioning, this is the time to cherry pick stocks, because some of the stocks may bottom out and say go up 20-25% from here rather quickly. And even if the small cap index dips again, they may not go back to the same lows. So the view is now is the zone where you want to keep looking at stock specific entry points, irrespective of the index from here on. A 15-20% correction from the top on the small cap index. A lot of broader market stocks have already fallen 20 to 30% from the top. So there are opportunities to be looked at right now. Instead of looking at the index, time to go cherry picking stock by stock.
All right, let's take a short break on that note. When we come back, we'll put the spotlight on, a little bit on macro side, some very interesting opinion on next generation reforms coming in from Sanjeev Sanyal, member of the Prime Minister's Economic Advisory Council. Sandeep, I'll play some bites for you shortly, and then we'll talk about capital goods space in order to participate in this growth when we come back. All right, so we spoke with Sanjeev Sanyal this afternoon on growth and the next generation reforms, which everybody is talking about, including our Prime Minister, and then we'll take the discussion forward with Sandeep.
The way to look at quality of growth is to look at the stability indicators. So are you generating high growth without generating inflation, without causing stress to the banking system, causing stress to your external accounts, and so on and so forth. And as far as quality of growth is concerned, in all of those parameters, inflation is running at about 5%, which is within the band. We are accumulating foreign exchange reserves. Our current account on the external front is well behaved. Our banking system is well capitalized and profitable. So none of those sectors are showing stress. So in terms of quality of growth, that suggests that we are generating high growth without causing macroeconomic stresses.
Sandeep, I want to understand, we spoke with the RBI governor recently. He said this year the growth should be closer to 8%. Sanjeev Sanyal earlier was telling us that now the aim of the government is to keep growth in the higher band, but on a sustainable basis rather than as a one-off. Are the valuations right to play this theme on the capex side and high growth side via capital goods stocks, and are there any capital goods stocks on your radar? Because till some time back, most of them got very expensive.
So Ajay, most of the capital goods stocks have not really become much cheaper. In fact, if you see like the stocks you're putting on the screen, L&T, Siemens, ABB, all of them, they have hardly corrected. Like L&T fell on the news of Saudi Aramco cutting down some capex, but then after that they won so many orders from the Middle East, including one large one today, that it's bounced right back. So the capex theme will remain intact, but I think such corrections. So on the mid cap side, we've still seen corrections. So I think something like an NCC, which went up to 265, fell to 210, so 20% cut. I think such stocks and all we should keep in the radar and buy them whenever such kind of sell-offs happen. My view is on the mid cap side of the overall market, the correction is not yet over. Even on the large cap side, we could still see some more correction, and that will give the opportunity. Directionally, I think the Indian growth path will remain strong for the next few years, and they actually don't need too much of reforms, except for the fact that consumption in India remains very constrained because of very high taxation. But this government is not inclined to cut taxes, so I'm not sure whether some relief will come for taxpayers out there. But if they do that, then I think we could have a much more sustainable growth, which is contributed both by capital, capex, government, private sector, public sector capex, services, consumption, etc. Everything.
I also want to understand a clutch of PSU stocks, NTPCs of the world, PFC, RSC, IRIDA, many others actually have corrected reasonably from tops. Would that be a good idea to get into some of these names which are down 30-40%?
Yeah, if they're
Sandeep?
down 30-40%, we can start looking at, but most of them are not down 30-40%. They'll be down barely 10-12%. And to that extent, I don't think they become any sort of compelling buy because it's a very, very overbought sector. All retail investors, HNIs, speculative traders, everyone has got into them. So my guess is that the public sector index itself should fall another 10-15%, and some of the stocks in turn could fall 15-20%. And at that time, there could be opportunities.
Oh, yes, that's an important point. Thanks very much for your time, Sandeep.
If you like this video, then like, share and subscribe to ET Now.